Hi everyone, and welcome to this week's Market Roundup. Just as it seemed like markets were beginning to settle, 2025 threw us another curveball, this time from the Middle East. Geopolitical tensions between the US and Iran intensified significantly over the past week and into the weekend, culminating in a major development that's gripped headlines and tested investor nerves across the globe. It started with US President Donald Trump using his social platform to demand Iran's unconditional surrender at the start of the week. He confirmed targeted US airstrikes on critical nuclear sites, focusing on locations widely known for their role in Iran's uranium enrichment program over the weekend. Trump's message at the start of the week was direct and chilling. Any retaliation would be met with force far greater than anything seen before. Again, at the start of the week, markets initially responded with caution. Oil prices surged, gold climbed, equity futures dipped, safe haven assets saw inflows, and investors braced for further escalation. But then midweek, a surprising shift. Just as tensions peaked, Trump announced a temporary pause in military action to allow space for diplomatic talks. For a brief moment, it looked like a pathway to de-escalation might be on the table. However, that sense of calm didn't last. In the early hours of Sunday morning, the US confirmed further targeted strikes on Iranian nuclear infrastructure. These new attacks represent the most direct and aggressive action taken against Iran's nuclear facilities in over a decade. And naturally, the markets are watching closely. Oil prices jumped sharply in early trading, with Brent crude spiking above $95 per barrel. The Strait of Hormuz, through which around 20% of the world's oil supply flows, sits dangerously close to this conflict. Any disruption to this key shipping route would have massive implications for global energy prices. At the same time, gold continued its upward move, while airline stocks and travel sectors suffered on fears of rising fuel costs and broader regional instability. We've also seen British Airways cancel flights to the Middle East so far. Despite these jitters, equity markets haven't collapsed, and that's an important point, because when we look at history, it reminds us that markets typically recover from geopolitical shocks faster than we expect. In fact, the S&P 500 has averaged a 14.2% gain in the year following major geopolitical events since the Korean War. After the Gulf War, it returned just over 10% in the 12 months after. Post-Iraq invasion, nearly 27%. Even after the Cuban Missile Crisis, one of the most dangerous nuclear standoffs in history, the market delivered a 27.8% gain the following year. Of course, not every scenario plays out so cleanly. The invasion of Ukraine in 2022 saw the S&P fall over 7%. But that wasn't just about war. It was also about rampant inflation, aggressive rate hikes, and an energy crisis across Europe. In other words, a perfect storm. In contrast, this current Iran conflict, while deeply serious, hasn't yet triggered a broader regional war or a full-scale ground invasion yet. The market's response so far has been one of watchful caution, not outright panic. Still, in moments like this, it's really easy to let emotions take over. When the headlines scream missile strike or retaliation, our instinct is to de-risk, sell, sit on the sidelines. But this is where investors often make the biggest mistakes. Looking back, some of the best days in markets tend to happen immediately after the worst news. Missing just the 10 best days in a year can drastically cut your return, from a healthy 8.2% to a negative 12.2%, as we've seen in April of this year too. Those best days are often clustered around the very periods of panic that tempt investors to step out. This was true after 9/11, true during COVID, and it may well be true again in 2025. So while the headlines feel uncomfortable, the rational response is to stay invested, stay diversified, and stick to your long-term strategy. Stepping away from geopolitics for a moment, we also had a key update from the US Federal Reserve last week too. As expected, the Fed held rates steady at 4.25 to 4.5%. But what caught investors' attention was tone. Chair Jerome Powell acknowledged that inflation is easing and hinted at the potential for 2 rate cuts before the end of the year. Markets initially rallied on this dovish outlook. Equities rose, yields dipped, and the dollar softened. Why? Because when interest rates come down, the cost of borrowing falls. That's good for business growth and earnings, and it makes equities more attractive relative to cash or low yielding bonds. On the fixed income side, lower rates mean higher bond prices, especially for longer duration assets. That's because existing bonds with higher yields become more valuable in a falling rate environment. So, if you're holding government or high quality corporate bonds, like a lot of you are, you're likely to benefit from any future cuts, which is great news. Of course, this rally was tempered slightly as the Iran situation regained the spotlight towards the back end of the week. But the underlying economic backdrop still looks strong. Inflation in the US rose just 2.4% in May, getting close to the Fed's 2% target. The labour market added 139,000 jobs and unemployment remained steady at 4.2%. These are not recessionary numbers. Meanwhile, over in the UK, the Bank of England also chose to hold rates at 4.25%. However, the tone suggested that a cut might be coming soon as August, especially if wage inflation continues to ease. The FTSE 100 moved slightly higher, the pound remained stable, and gilts followed US Treasuries downwards. What's flown under the radar in all of this is the return of the tariffs. President Trump announced sweeping new duties on steel, aluminium, cars, appliances, and key tech imports, mostly from China and the EU. While the UK was excluded from some of these tariffs, it still marks a clear return to protectionist trade policy. Manufacturing, autos, and electronics could see short-term pressure, but the softer dollar has helped exporters stay competitive and commodity prices have held up well. Now back to the Middle East and energy markets in particular. This remains the most sensitive part of the current geopolitical puzzle. If Iran retaliates by disrupting oil flows through the Strait of Hormuz, as they've suggested, prices could surge even further. If we look at who this would likely benefit, oil majors like Exxon, Chevron, BP and Shell would stand to gain from higher crude margins. These companies are well capitalized and some may even see earnings upgrades if energy prices remain elevated. That said, volatility in this sector is high and the situation is extremely fluid. What was said last week didn't hold true over the weekend, and who knows where we'll get to this week. So what are we doing about all of this at Hoxton Wealth? Well, first off, really key to note, we're staying true to our process. We've built portfolios designed to withstand shocks like this. That means a blend of active and passive strategies diversified across asset classes and regions. We ensure you hold cash for short-term needs and equities for long-term growth. Earlier this year, we reduced our US equity exposure and increased weightings in Europe and the UK. With rate cuts on the horizon and more attractive valuations in those regions, that call has so far played out well. We're also keeping a close eye on energy, commodities, and defensive assets like gold and inflation-linked bonds. But rest assured, we're making sure that we're keeping a close eye on the situation. These are the tools we use to manage risk without abandoning opportunity. In times like this, it's easy to get swept up in fear. But we know markets are forward-looking. They absorb risk, reprice quickly, and move on faster than the headlines might suggest. So our message this week is simple. Don't let the current escalating tensions derail your long-term strategy. Stick with the plan, stay diversified, and realize that what might seem huge today may not seem so big in 12 months' time. We are in this for the long run, and as such, we must treat our investing decisions along with this, a long-term thought process. As the situation evolves, we will of course keep you updated. And if you have any questions or concerns, as always, please speak with your advisor or email us directly at client.services@hoxtonwealth.com. Thanks for joining us. We'll keep you updated throughout the week, and we'll see you next time for the next episode of the Weekly Roundup. Thanks very much. Have a great week ahead.